There's a teacher in Columbus, Ohio who retired last year with $1.4 million in her investment account. She never worked on Wall Street. She never read an earnings report. She never owned a single individual stock. What she did was move $500 a month into the same account, every single month, for 32 years, and then she did something most people are completely incapable of. She left it alone. Here's the part that will mess with your head. $500 a month over 32 years is $192,000 out of her own pocket. The other $1.2 million came from somewhere she never touched, never managed, and never had to think about. She contributed less than $200,000 and ended up with over $1.4 million. The math behind that gap is what this entire video is about. My name is Robert, and I spend probably too much time running numbers on things that sound impossible until you actually run the numbers. If you want to understand how real wealth gets built, not the crypto moonshot version, the version that actually works for actual people, hit subscribe because today we're pulling this apart completely. Every number, every variable, every mistake that stands between you and a seven-figure outcome starting from $500 a month. Quick note before we go deep. I'm not a financial advisor. This isn't financial advice. This is math, history, and the mechanics behind one of the most powerful forces in the known universe, which sounds dramatic until you see what it does to $500 over 3 decades. Let's start with what $500 a month actually is. Because the framing matters enormously here. $500 is $125 a week. It's $16.60 a day. 1 dinner out, 2 streaming subscriptions, 3 impulse purchases, and a tank of gas. For most households, $500 a month is not a life-changing sacrifice. It is, however, a life-changing habit. And the difference between those two things is the entire game. Because here's what most people do with $500 in extra cash. They absorb it. The lifestyle quietly expands to fill whatever space the income creates. The slightly nicer apartment. The upgraded phone. The subscription you don't remember signing up for. This is called lifestyle inflation, and it is the single most effective wealth destroyer in the history of the middle class. It doesn't feel like a disaster. It just feels like living your life. And then one day you're 55 staring at a balance that was supposed to be a lot bigger than this. Now let's talk about the vehicle. Because this is where people make the first big mistake. They hear, invest $500 a month, and immediately start researching stocks. Individual companies. Sectors. The next big thing. And look, I understand the appeal. Picking stocks feels active, intelligent, optimistic. It feels like you're doing something. The problem is the data on what happens when regular investors try to do something is brutal and consistent. Dalbar, a financial research firm, has tracked this gap for over 30 years. In 2024, the S&P 500 returned just over 25%. The average equity investor earned 13.8%. Same market. Same funds. Nearly 12 percentage points evaporated through bad timing and emotional selling. The fix isn't smarter stock picking. The fix is removing the decision entirely. And that's exactly what a low-cost index fund does. It owns everything in the S&P 500. Every month your $500 buys fractional ownership of Apple, Microsoft, Amazon, Nvidia, and 496 other companies simultaneously. When one falls apart, the others carry it. When the whole market drops, you just bought more at a discount. It is the most boring, most thoroughly proven investment vehicle in the history of finance. And the fees matter more than almost anyone realizes. The biggest S&P 500 index funds charge around 0.03% per year. 3 cents on every $100. Actively managed funds charge around 1%. Over 30 years, that 1% difference costs you roughly $120,000. Not to bad investments. Not to market crashes. To fees. It's entirely avoidable. Now let's run the actual numbers. $500 a month. 10% average annual return, the S&P 500's long-run historical average. Here's what time does to it. At 10 years, you've put in $60,000. Your balance is roughly $102,000. The market handed you $42,000 you didn't earn through labor. At 20 years, you've contributed $120,000. Your balance is approximately $382,000. The market generated $262,000 on your behalf. More than double what you put in yourself. At 30 years, you've put in $180,000. Your balance is sitting at roughly $1,130,000. You are now a millionaire, and the majority of your wealth was built by money working on your behalf while you were sleeping, working, watching bad television on a Tuesday. At 35 years, that number crosses $2 million. And the wild part is the last 5 years added almost as much as the first 25. That's the back half of a compounding curve doing exactly what it was always going to do given enough time. This is what compounding actually is. Your returns generate their own returns, which generate their own returns, which eventually start doing more work than you ever did. The machine does not care about your income, your zip code, or your feelings about the economy. It just needs two things: time and consistency. But here's the uncomfortable part. The reason most people don't end up with $1.1 million from $500 a month isn't the math. The math works for everyone equally. The reason is behavior. 3 specific behaviors that silently destroy compounding before it ever gets to work. The first is the pause. Market drops 20%. Your balance goes from $80,000 to $63,000. Everything in the news sounds like the beginning of the end. So you pause the contribution. Just for a month or two. Just until things stabilize. Here's what that pause actually costs you. You just missed buying $500 worth of every major American company at a 20% discount. The recovery happens, as it always has, and you bought less of it than you would have if you'd stayed automatic. The second behavior is the raid. Emergency comes up. The account is right there and it has money in it. So you pull $5,000 out and tell yourself you'll put it back. You usually don't. And even if you do, in year 25 that $5,000 wasn't $5,000. It was the $54,000 it would have become by year 35. That's the real cost, and it never shows up on the withdrawal screen. The third is the restart. Life changes. Job changes. Move. And somewhere in the chaos the automatic transfer gets cancelled. Not on purpose. Just not restarted. 6 months go by. A year. And it becomes one of those things you'll definitely get back to eventually. The compounding continues on a smaller base, and the final number is dramatically different from what it would have been if the transfer had just kept running. The solution to all three is the same, and it is almost insultingly simple. Automate it and make it hard to access. Set the transfer to happen the day after your paycheck lands. Before you see it. Before you budget around it. The money that leaves before you touch it is the money that actually compounds. Now let's talk about where to hold it. Because this matters almost as much as what's inside it. If your employer offers a 401k with any matching contribution, that match is the closest thing to free money in the legal financial system. If your employer matches 50 cents on every dollar up to 6% of your salary and you're not contributing at least 6%, you are leaving actual compensation on the table. Not investment returns. Compensation. The match always comes first. Before everything else. After the match is maxed, the Roth IRA is usually the next best home for your $500. In 2026 you can contribute up to $7,000 a year, roughly $583 a month, almost exactly our target number. Money goes in after tax, grows completely tax-free, and comes out in retirement without a single dollar owed to the IRS. On a 30-year compounding timeline, the difference between paying taxes now on $500 versus paying taxes later on $1.1 million is not a small number. And most people qualify. And if $500 feels like the ceiling right now, that's fine. The math doesn't require $500 from day one. It requires consistency more than a specific number. $200 a month from age 25 beats $500 a month starting at 40 because of what those early years buy you. Starting is always the right move. The amount is something you optimize later. Right now in 2026, market valuations are historically elevated. And every few months someone on financial media will tell you this is precisely the wrong time to start. Wait for the pullback. Wait for clarity. Wait for something. Here's what the data actually says about waiting. Researchers studied the worst possible market timing imaginable. An investor who put money in only at market peaks right before every major crash for 40 years. Even that investor ended up significantly ahead of the person who held cash waiting for a better moment. Because time in the market is the variable. Not timing the market. The $500 a month strategy sidesteps this debate entirely. It buys at every price automatically. When markets are high, you buy a little. When markets drop, you buy more for the same $500. The average cost smooths in your favor while the waiting crowd watches their cash slowly lose purchasing power. So let's come back to where we started. A teacher in Columbus. $500 a month. 32 years. $1.4 million. No stock picks. No market timing. No financial genius required. Just a transfer that ran on the first of every month until the number stopped feeling real. Here's the whole thing in one breath. Start with the employer match because it's free money you're currently declining. Open a Roth IRA and fund it with a low-cost S&P 500 index fund charging less than 0.1% in fees. Automate the transfer so it leaves before you can spend it. Do not pause it when the market drops. Do not raid it when something feels urgent. Leave it alone with the same energy you'd leave a sleeping baby in a running car. And then go live your life because the account will do the rest. The math has been working for every person patient enough to let it. It will work for you too. But only if you start. Thanks for watching. I'll see you in the next one.